Hey there, and good afternoon, everyone. This is Trader Tim coming to you on this final day of 2018. Today's Monday, December 31st, 2018, and wanted to kind of wrap up the year, talk a little bit about what's happened here in this last week. And to do that, I'm going to start by zooming out, and I'm going to go all the way to a monthly chart. Let's do a 10-year monthly. And when you back out, amidst some of the clutter from my chart here, you can see a pretty sizable pullback, but in the context of a very, very strong uptrend. Uh, I've been relating this year or this sort of start of the pullback to what we were seeing in 2015, 2016, where we moved sideways but had some of these bigger dips in here with long tails, and then that fueled another strong rally. So as you can see here, I've got a low from that 2016 low to all-time highs in the E-mini S&P, and that's right where we've bounced this last week. And typically, I'll have to say this is the first time period between Christmas and New Year's that I've seen this kind of volatility and activity. Usually, it's very, very quiet, and in part with I think the government shutdown here in the U.S. and some of the other things happening out of the White House that in most years would be a little bit quieter. That added some fuel to the fire. But nonetheless, I didn't have any trades this week. The only thing I did was add to some longer term positions in my IRA. So if we go down to a weekly chart, I used this bigger retracement as an opportunity to take some of that cash that has been piling up just from weekly deposits that I have transfer from checking into my brokerage accounts, into my retirement accounts, things like that. After it piles up, I look for opportunities when the market pulls back in a sizable chunk to buy more, to add to some of those longer term positions. And so that's really all I did when we came down here to 23.75. So if we go lower, that's totally fine. But at this point, buying down here is certainly a lot better priced at a discount than buying last December up here at highs. And if you remember, things like Bitcoin last year were just shy of 19,000. Currently, it's not even above 4,000. 3690 is where we're sitting. So lots changed since last year to this year. And if I zoom in a little more and we kind of make sense of some of these drawings that I have, weekly chart, um, I've got the swing high here going to lows because that was the swing high that we had tested a number of times and sold off from. So then I just grabbed that sort of most recent swing high on the weekly chart to lows. And that gives us a bounce point of about 2570. Now if we come down and zoom in a little bit more on the daily chart, we can see a couple of we had the 1,000 point day in the Dow. No surprise, the biggest up moves come in the context of bear markets. And so the last couple days of rally have adhered fairly nicely to some 50% retracements. On the 30-minute chart, you can see over a period of just 2 days rallying and then pulling back to the 50 and then bouncing again. We have not pulled back to the next 50. I'll get rid of this one here. And so you can see that 2460 below us, 2570 above us. If I get rid of both of those just to clean things up, go back to the daily, you can see sort of a lot of times what happens is we get this bounce, but then we start to flatten out. And so I'd be looking for, at this point, Friday, the 28th's low, if we break that low, then I'd look for us to roll over. Otherwise, if we keep going higher, then whatever that highest price, that highest bar that contains the highest price, which as of right now is the 28th, that would be the sort of reversal bar. And let's go over to the SPY. It's a little bit clearer here. So, for example, this guy up here, this candle had the highest price in this little rally here. So a rally, 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 highest price. And so when the candle with the highest price breaks its low, also known as what I call low of the high bar, that's the signal for the reversal, and that's when we start to move down. Same thing back here. We're moving up, 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 and we get this little high bar. We break its low, and then the market pulls back. Same thing over here. So when you're in the context of a downtrend, it's usually pretty strong. And so I'll be looking for that to play out, breaking one of these candles' lows to sort of start a potential rollover. You can see increasing volume on the way down, decreasing volume on the way up. So pretty strong likelihood of at least a retest of 2375s. The first couple weeks in January can be a little bit telling towards the year. So if we start January going into February in some sort of trend, in a downtrend, let's say, then it's likely that we'll move in that direction through the spring. The markets have been moving a lot faster, and so some of these sell-offs, by the time the news media really gets hold of, you know, we're in a recession, the economy or the stock market is tanking, by that point, the stock market's likely to already be on the rebound and rallying. I mean, it was 2012, 2013, 2014, and people were still talking about, the market's in a recession. But if you come out, if we go back to that monthly chart in, actually, I got to go 15. We, yeah, this is why. There we go. SPX. It was that sharp sell-off, but then by the time we were in, mid 2009, the market's on a tear, and the media is still, talking fearful, talking about all of the bad things. And if just looking at this chart, I mean, you come back and you look at, okay, top of 2008. If you just wrote it out, look at where we are now. I mean, we're so much higher than 2008, and plus all the dividends and growth and everything else that you accrue over that time. So people tend to forget very quickly, and you just want to remember that this is where a lot of money is made in these big pullbacks. A lot of opportunities start to show themselves in these types of environments, after a big dip. And that's what we're getting over here. Let's just be completely radical and draw a full retracement from the low of 2009 to highs. Takes us to a S&P 1800. I mean, we're still above 2008 highs, or 2007 highs. So the market corrects, the market pulls back, and you want to see those as opportunities to, be looking for investments and, piling away cash in these good times so that you can start deploying that cash and putting it to work for you in the, rougher times. And if you've done it right, then, those what are rough times and hard times for most of the folks in the economy will be very good times for you. Not in a way that we're taking advantage, just that we're remembering that the market does correct itself, and you gotta reduce your debts, pile on cash, and the more cash you have, the more opportunities that you can put that to good use in various investments. So that's kind of how I see the last, really the last couple of months, and kind of recapping 2018, going into 2019. There's definitely room to move to the downside, but the stock market is very much separate from the economy, and so even if the economy still stays strong, it doesn't mean that we can't sell off here in the stock market, and that may end up leading the economy into a some sort of bigger recession. But even so, if you remember back to 2008, yeah, things are hard uh, on the whole, but you do your best to look for those opportunities and prepare yourself for when the corrections come. So I wish everyone a good rest of 2018 and a happy new year. We'll be resuming the Tuesday trading room next week. And as always, if you have any questions or want to chat about your trading in particular, feel free to email me, tim@eminimind.com. Wish you all a great evening and have a great Happy New Year.